Most money is born as a loan, not mined, not printed, not found, issued when someone signs a promise to pay. That one idea explains why economies can grow fast, crash hard, and why debt seems to stick, even after a crisis ends. If you get this, headlines about money printing start to look like the wrong map. Now here's the part most people get wrong. The constraint isn't a simple multiplier. Start with a simple scene. You walk into a bank and borrow $10,000 to buy a used car. You imagine the bank hands you someone else's saved cash. But in a modern banking system, the bank often creates a new deposit at the moment it issues the loan. On the bank's balance sheet, two entries appear at once. The loan is an asset. You owe the bank $10,000 plus interest. The matching deposit is a liability. The bank owes you $10,000 that you can spend. No vault needs to open first. The act of lending creates purchasing power. Now scale that up to a mortgage. When a bank approves a $300,000 home loan, it typically credits the borrower's account, and that money is used to pay the seller. The seller now has a bigger deposit balance. A new loan created a new deposit, new money in the form people actually spend. When you move that deposit to another bank, settlement happens in the background. Banks settle with central bank reserves, like chips used only inside the casino. You don't spend reserves at the grocery store. You spend deposits. Reserves are for bank-to-bank plumbing, and they matter because they keep payments flowing. That's why banks can create deposits, but not without constraints. If too many payments flow out, a bank must replace funding, attract deposits, borrow in markets, sell liquid assets, or access central bank facilities. Most days, this is routine. In a panic, it's survival. Zoom out. Repeat this across millions of loans. Credit cards, business credit lines, auto loans, student loans, mortgages. In each case, new lending tends to create new deposits somewhere in the system. So, when credit expands, money expands. And when credit contracts, money growth slows or reverses. One more subtle point. The money most people experience is bank money deposit balances. Physical cash exists, but in many economies, it's a small slice of total spendable balances. That means the health of money is tied to the health of bank balance sheets. Once you see what really limits lending, the next question is, what happens over time? The credit cycle. People often explain this with a money multiplier, as if banks take reserves, multiply them, and deposits mechanically appear. That's the old classroom story. The modern view flips the arrow. In practice, banks don't sit around waiting for reserves before they lend. They lend when they see profit and acceptable risk, and when they believe borrowers can repay. After lending, banks manage settlement and funding. They attract deposits, issue bonds, borrow from other banks, or use central bank facilities. Reserves follow the lending, not the other way around. This also explains why central bank actions can be misunderstood. When a central bank buys assets, like government bonds, it may increase reserves in the banking system. But more reserves don't automatically force more lending, because reserves are not the binding constraint in normal times. Lending still depends on capital, underwriting, and borrower demand. So what actually limits lending? Capital. Banks must hold an equity cushion against losses. If a bank makes too many risky loans, expected losses rise, capital ratios fall, and the bank must slow lending, raise capital, or shrink. Liquidity. Even a solvent bank can fail if it can't meet withdrawals and payments on time. Stable deposits, high-quality liquid assets, and backstops matter. Regulation and risk appetite. Underwriting standards, stress tests, concentration limits, and the simple fear of being wrong. Creditworthy demand. Banks cannot force people to borrow. If households are over-leveraged or businesses see weak sales, credit demand collapses and money creation slows even if rates are low. And this is where the system gets brutal. When the cycle turns, defaults reveal who was actually holding the risk. This is how credit cycles form. In the early phase, lending grows because the world feels safe. Employment rises, asset prices climb, and defaults look low. Banks loosen standards a little. Borrowers stretch a little. Investors chase yield. Everyone tells themselves it's rational, because the recent data looks good. Then credit growth itself changes the world. More lending means more spending power. More spending can lift incomes and profits, but it can also inflate asset prices. Homes, stocks, commercial real estate, those rising prices become collateral, which supports even more borrowing. The system begins to loop. Higher prices, easier borrowing. More buying, higher prices. This is why leverage hides best in good times. Rising prices make balance sheets look stronger, so risk models calm down. Refinancing becomes easy. Liquidity feels abundant because everyone is willing to lend against assets that keep appreciating. The turn usually comes from a squeeze. Rates rise, cash flows tighten, or expectations shift. The weakest borrowers start missing payments. A few defaults don't matter. What matters is the change in belief. Lenders go from, "How much can we lend?" to, "How fast can we reduce risk?" As lenders pull back, fewer new loans are created. That means fewer new deposits are created. Money, growth, slows. Spending slows. Asset prices stop rising, collateral weakens, and refinancing becomes harder. The same credit machine that created money easily can stop creating it almost overnight, and that feels like money is disappearing, even though it's really the creation engine stalling. Policy often responds by cutting rates, providing liquidity, and encouraging banks to keep lending. But if confidence is broken, the private sector may still deleverage. That's when recoveries become slow. Less credit creation means less money growth. So here's the clean takeaway: what to remember and what to watch in the real world. Now the uncomfortable part. If money is created as debt, what happens when debt can't be paid? When a borrower repays a bank loan, the opposite of creation occurs. The bank's loan asset shrinks, and the borrower's deposit shrinks. Repayment destroys money. That's not poetry, it's accounting. In a healthy expansion, new lending typically outpaces repayment, so deposits grow. But in a downturn, repayment slows and defaults rise. A default does not magically erase the obligation from the system. It shifts the loss. The borrower can't pay, so the bank takes a hit to capital. If losses are large, the bank must reduce lending, raise capital, sell assets, merge, or in extreme cases, fail. This is why debt appears to never disappear. Even if one borrower's debt is wiped out in bankruptcy, someone else is left holding the loss. Shareholders, bondholders, deposit insurance funds, or taxpayers through government support. The financial system is a web of claims. When one promise breaks, the shortfall shows up on another balance sheet. And what about interest? The interest comes from income and cash flow generated in the real economy. Wages, profits, taxes. But system-wide, interest makes the treadmill visible. Debts require ongoing cash flows and often ongoing refinancing to remain serviceable without mass defaults. In practice, many debts are rolled over. Old loans are paid off with new loans. The balance changes hands, but the aggregate level can remain stubbornly high. Governments behave this way too. Sovereign debt is often refinanced continuously. It doesn't disappear unless it's paid down with surpluses, inflated away, or restructured. Different label, same logic. Obligations persist, and the burden lands somewhere. So debt doesn't vanish. It gets repaid, destroying money, restructured, changing terms, written down, creating losses, or socialized shifting burdens through policy. The form changes. The cost shows up somewhere. Alright, here's the clean takeaway. If you remember only 3 things from this video, make it these. Here's the takeaway. Modern money is a credit instrument, and credit is a confidence cycle. Remember 3 rules. Loans create deposits. Most spendable money is born when banks extend credit. Limits are human, not mechanical. Lending is constrained by capital, liquidity, regulation, and confidence, not a simple multiplier. Debt doesn't vanish, it transfers. Repayment destroys money, default creates losses, and policy decides who ultimately carries the weight. Practical test. When you hear money is flooding the system, ask one question: is private credit expanding? Or are we just rearranging balance sheets? Follow the loans. Follow the balance sheets. That's where money is born and where it breaks.